Hey everyone, welcome back to Corporate Decoder. Today, MIRA Pharmaceuticals just filed an 8K report about a delisting warning, and I am seeing one big red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing tells us if the company is about to get kicked off the stock market, and there are some serious steps they need to take to avoid it. So what is happening here is that MIRA Pharmaceuticals Incorporated received a letter from the Nasdaq Stock Exchange. Basically, Nasdaq is saying that MIRA's stock price has been too low for too long. Specifically, for 30 days in a row, the stock price has been below $1. This is a problem because one of the rules to stay listed on the Nasdaq Capital Market is that your stock price needs to be at least $1 per S-share. This is often called the minimum bid price requirement. The letter itself doesn't mean they are kicked off immediately. Their stock still trades on the Nasdaq Capital Market under the symbol MIRA for now. Now, the good news is Nasdaq gives them a chance to fix this. MIRA has 180 days, which is about 6 months, until the 25th of January 2027, to get their stock price back above $1. To do this, the stock needs to close at $1 or higher for 10 consecutive business days within that 6-month period. If they don't manage to do that in the first 6 months, they might get another 180-day extension. But to get that second chance, they need to meet all the other Nasdaq listing rules, like the total value of their stock being publicly traded, and they have to tell Nasdaq they plan to fix the problem, possibly by doing a reverse stock split. A reverse stock split is when a company cuts down the number of shares outstanding, making each share more valuable on paper, but not changing the overall value of the company. However, if Nasdaq thinks MIRA just can't fix the problem, they will tell the company that their stock will be delisted. Then M.I.R.A can appeal this decision to a special Nasdaq hearings panel, but there is no guarantee that this appeal would be successful. The company's common stock is currently trading on the Nasdaq Capital Market. As of the latest information we have, the stock price is around 79 cents. This filing confirms the company is struggling to maintain that $1 minimum. Historically, companies that get these types of warnings often face significant challenges. About half of micro cap companies that go through reverse stock splits end up being delisted later. Think about Kodak back in 2021, they did a 1-for-20 reverse split, and their stock kept dropping, eventually leading to delisting. A $1,000 investment at that time could have quickly become worth much less. MIRA is also marking itself as an emerging growth company, which means they have some flexibility with accounting standards. They have also elected not to use the extended transition period for new or revised financial accounting standards. This suggests they are trying to stay current with financial reporting rules, which is generally a good sign for transparency. Looking at MIRA Pharmaceuticals Incorporated, it is a company in the healthcare sector, specifically drug manufacturers. Their market cap is around $33 million. Recent news shows they are working on oral drug candidates for pain and have expanded a license for ketamine negative 2. This indicates ongoing research and development efforts. However, the current stock price hovering below $1 is a major concern and clearly overshadows any positive news about their drug pipeline. The report is signed by M.I.R.A, the Chief Executive Officer. This means the leadership is aware of the situation and is taking responsibility for the company's filings. He is indicating that the company intends to monitor the stock price and consider options to get back into compliance. In my opinion, M.I.R.A Pharmaceuticals is in a precarious position. While they have ongoing research in drug development, the persistent low stock price is a serious problem. Nasdaq's warning is a clear signal that the market is not valuing the company's stock highly enough to meet listing requirements. They have a tough road ahead to regain compliance. And the threat of delisting looms large. The risk I'm watching is whether they can execute a successful strategy, like a reverse stock split, without further alienating investors or triggering a delisting. What I am actually looking for is a sustained increase in their stock price driven by real business progress, not just a cosmetic fix. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.